Chang, and this is Bloomberg Technology. Coming up, big media comes up small on ad revenue in the first quarter after losing the most households in pay TV last quarter. Our roundtable discusses why. Plus, banking on Britain. Square CFO Sarah Friar joins us with details on why the payments company circled the UK as the starting point of its European expansion. And two of the world's biggest retailers prepare for digital war, why Walmart's acquisition spree may be the ammo to take down Amazon. First to our lead. Media companies are getting clobbered this week with weak ad revenue emerging as a trend in first quarter earnings results. However, CBS just reported its results after the bell, revenue totaling $3.34 billion, and that's a beat. Still, the fear of cord cutting is intensifying. A record number of pay TV subscribers cut the cord last quarter, and they're moving online. I want to bring in Paul Sweeney, Director of North American Research at Bloomberg Intelligence. So, Paul, let's break down CBS first. How are they bucking or reinforcing some of these trends?
You know, CBS had pretty good numbers today. As you mentioned, they beat on both the top line and the bottom line. You know, when you strip out, the Super Bowl and some one-time items, they did say that revenue at the CBS network was down just slightly. So they are they are also feeling some of the impacts of a slowing advertising environment, but they're also benefiting from a lot of other revenue streams. They are licensing a lot of the content, the TV content that they produce. They're licensing it to other players, such as Netflix, both domestically and internationally. So they had some good revenue from the licensing side of the business, but they are clearly, I think, probably the most bullish on the advertising outlook as they head into the upfront season in a couple of weeks.
Jerry Smith is also joining us now, our Bloomberg News media reporter. Jerry, I want to ask you about this loss in subscribers. I mean, obviously, we're seeing an impact on the stocks, but cord cutting has been around for the last several years. Why are investors now so spooked by this?
Well, it has been around for several years, but as we saw in this first quarter, it appears to be accelerating again. There was some fears about this a couple years ago. We just saw it. This was the worst first quarter for pay TV distributors in terms of subscriber losses ever, according to a couple analysts. So, this is something that investors and media stocks really look closely at, is cord cutting, and we're starting to see in this past quarter that it was, is really becoming more and more of an issue.
Meantime, Hulu, AT&T, Dish, Sony, YouTube, all of these are companies that are convinced they can lure customers back by a slimmer live TV package that's cheaper than your, say, traditional cable package. Paul, are customers going to buy in?
It remains to be seen. We're still very much in the early innings. A lot of these over-the-top services or virtual cable companies, if you will. But I think the expectation is that for the content companies, the Viacoms of the world, the Time Warners of the world, the folks that create all the movies and TV shows that people watch, they believe that they will come out in just fine shape going forward as long as they can get paid by whomever is carrying their service, whether it's a traditional cable company like Comcast or whether it's some new player such as Netflix. So the challenge for the media companies is to make sure that they get paid every step along the way by whoever wants to distribute their content.
We're seeing drops in ad revenue at Time Warner, AMC networks. To a certain extent, it's a vicious cycle, Jerry. But what exactly is behind this?
I mean, there's a couple of things behind it. There's certainly the media executives say that there's broader macroeconomic concerns that are causing advertisers to hold back a little bit. But then there's also just TV ratings are declining, and the TV networks are trying to charge higher prices for commercials, but advertisers are saying, wait a minute, you're charging me higher rates, but I'm reaching fewer viewers. And we're starting to see that those higher commercials aren't making up for the fact that ratings are continuing to decline. So it's sort of on a big macro level, and then also related to the TV industry itself.
What about uncertainty around President Trump's policies, Paul? Is that at play here?
I think it is. We heard last week from the large global advertising agencies, in particular Sir Martin Sorrell from the WPP Group, the largest ad agency in the world, cited the uncertainty around the new administration as one of the reasons that the North American market for WPP was particularly weak in the first quarter. So I think a lot of investors, a lot of advertisers are just kind of sitting on the sidelines a little bit with some of their discretionary advertising budgets, and they want to see how things are going to shake out in terms of some economic policy in the U.S. So that has definitely been called out. The question is, will they come back later in the year? A lot of the media companies expect them to do so. That's why the upfront selling season, which really kicks into gear in the next couple of weeks, where the networks sell most of their advertising inventory in the upfront market, that's going to be a very important time for these big media companies to see as to the health of the advertising in the market.
Meantime, the up-and-comers like Amazon and Netflix are spending billions of dollars on original content. In the beginning, it was just House of Cards and Transparent, but now there are more original shows on these streaming companies than I can keep up with. Jerry, is it going to pay off, or is there going to be some kind of comeuppance?
I mean, I think we are starting to see that, some of these cable networks that weren't really that big into original series, and now they're trying to create more original shows. There's been a few examples where it hasn't worked out for them, and they've sort of stepped back a little bit. It's very expensive to make original scripted shows. Certainly Netflix and Amazon are lavishing billions of dollars in this space. And so the television networks are trying to keep up. But there's been a few media executives, in particular John Landgraf at FX, who's been sounding the alarm on this and saying that we may be reaching peak TV, that maybe the economics of the television industry can't sustain this. And that's partly because the viewers are getting fragmented in all sorts of different ways, and so the audiences aren't as big, and the advertising's not there like it used to be.
All right, obviously something we'll continue to follow. Jerry Smith, our Bloomberg News media reporter, and Paul Sweeney of Bloomberg Intelligence, thank you both. Well, Facebook has backed away from the pricey venture of live streaming sporting events. Speaking on Wednesday's earnings call, CEO Mark Zuckerberg said the company plans to pay for content by sharing ad revenue. Traditionally, the major leagues have rejected that model, preferring to simply sell their rights for lucrative fees. Recently, Amazon agreed to pay $50 million for the NFL's 10 Thursday night games, and Verizon will reportedly pay about $21 million to stream just one NFL game. Still ahead, analysts say Square hit its sweet spot with earnings Wednesday, but is it sustainable? We'll hear from Square CFO Sarah Friar. And Bloomberg Tech is live streaming on Twitter. Check us out at Bloomberg Tech TV, weekdays 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. Square climbed to an intraday high Thursday after reporting better than expected first quarter results. The company, run by Twitter's Jack Dorsey, wooed larger merchants and impressed with newer software products. Still, some analysts are skeptical about long-term growth. The company processed $13.6 billion in payments last quarter, up 33% year over year. Earlier, I caught up with Square CFO Sarah Friar and asked if that rapid growth rate can keep up.
I think there's a lot of growth drivers in front of us right now. So I'd never want to undersell the core. So what we do in terms of small businesses, micro merchants coming onto the payment system for the first time, still a ton of opportunity there, right? 20 million small businesses in the US don't accept electronic payments. And now with countries like the UK, we see that same thing coming through. Then we're starting to move up market. So the product, as it becomes more feature full, is resonating with larger businesses. International, so I mentioned the UK, but now we're in 5 countries in total. And then finally, the other products that we've built around our ecosystem are starting to really gain a lot of momentum. Capital, Caviar, Square Cash, and so forth.
Let's talk about the international expansion. What have you learned from your launch in the UK in the midst of Brexit?
Yeah, so we love the UK market. So 5.5 million small businesses, incredible revenue that they generate, right? Really the lifeblood of that economy. What we see there is similar to the US. Half of them don't accept credit cards, so we know they're missing a sale. So I think in terms of what Square brings, it's the same story, the same value proposition here in the US. But what's different for us on the UK launch is we launched with a really full set of products. So not just payments and point of sale, but a product like invoices, our whole API Build with Square platform. So you can be both offline and online. That's very different for us to come to a market so fully featured from the get-go. And I think what we're learning there is that now we're seeing businesses of all sizes coming to Square right from the beginning.
What are the biggest risk factors with international expansion?
I think ultimately ultimately, it's about making sure we can maintain our culture and the brand that we've built so strongly here in the U.S. Because as soon as you're at a distance, you need to make sure that that culture is staying quite strong. I think secondarily, every market is different. So while you want a strong kind of maintaining of the culture and the value prop and so on, you also have to allow international markets to be a little different. I just was in Australia this quarter. The Australian market, probably leans a little bit more into being a little quirky, a little bit more funny, a little bit more actually competitive in how they brand, something that we probably wouldn't do here in the US, but we're more comfortable doing in Australia. And so we have to allow our country managers the leeway to do what they see right to really grow their markets.
So how far up market does Square want to go? I mean, we know you experimented a bit with Starbucks. That's now off the table.
Yeah.
But, where do you go from here? Would you ever get back to something like that?
Yeah, I don't think we view it as there being a point where we can't go any further. I think the key, though, is making sure that we do it much more in a methodical move up market. We tend to find bigger customers, just like the small guys, come to us, which is great. So the brand resonates. We're not doing outbound reach. But the key is making sure that we're not customizing software for bigger companies. I think this is where the API platform really comes into its own. So if you are a bigger merchant and you want to do something innovative and new with your checkout, North Face is a good example. Maybe you want to do a pop-up at a ski resort. Square can work really well for you, but we need to be able to allow North Face to build back into their ERP system or into their CRM system, because they're not going to rip and replace that all at once with Square. We're not quite there yet for something at that scale.
So how do you see the payments landscape evolving between Square and Apple Pay and PayPal? What does it look like in 2 years, let's say?
Sure. So I think there are really big market trends going on that are helping all of us. So even since I joined Square, the shift to electronic payments, the shift to using cards instead of cash and check, right? That has been ongoing now for decades. But even in the last 5 years, the US has made a really big shift there. So think back, you would see signs saying we're cash only. Like today, that's becoming less and less viable because your buyers are walking in and they don't have cash on them. So that's a rising tide. I think the shift to mobile and wanting to do more and more with your device, that sort of electronic payment, it's amazing to me in the US how low the penetration is of contactless payments, right? Being in Australia, 70% of all payments happen with a tap, and the US is just slow to that. But it will happen. It's an inevitability. And so when I look at that whole environment that's opening up, I think that's really good for all of us who are in the technology space, helping the seller be able to accept anything and then helping the buyer have a really unique and different experience.
You mentioned caviar. We reported that Square once tried to sell caviar, but now it seems to be, very much on the table in terms of something that you're building out.
Yep.
What is the future of caviar? Will we see more of this?
Yeah. So again, and it's a good link back to something like Analyst Day, it's reminding the strategy of why. So when we looked at the vertical of food, Square is very strong, starting in food trucks, going into quick service restaurants. But when we get into full service restaurants, our software is still evolving to really serve that category. So we said, what else can we do that this group needs? And delivery was one of the things that they needed to never miss a sale. And so we bought Caviar at the time with a view that ultimately we want to have a whole ecosystem for restaurants, but we're going to jump ahead a little. So Caviar today, we're kind of almost backfilling. So it does delivery. We moved into pickup again this quarter. And slowly the point of sale and the payments piece is becoming fully featured enough that a restaurant can also use it. So it does come back to a strategy of being a technology platform for food delivery and pickup, not just why are you in the food business? That seems strange.
Will we see more acquisitions along those lines, or more acquisitions to build out that particular area? We always want to keep flexibility across the board when we think about corp dev. So one thing we did in the quarter was we raised a convertible debt instrument, so $440 million on the balance sheet. I got asked a lot about why. Nothing imminent, but my job is to make sure Square always has the flexibility we're going to need to keep growing a really big, impactful business. We also could be hyper opportunistic, right? The debt market hadn't seen a lot of action, frankly, and Square was viewed as a really first-class issuer, so great terms. With that balance sheet, we can clearly keep looking at the M&A landscape, and if there was something out there that made sense, where we thought there was good value, where we thought we could show a return, we won't be shy about that either. That was Square CFO Sarah Friar. Well, the Paris prosecutor's office is investigating whether fake news is influencing Sunday's presidential election in France. Prosecutors started the probe into accounts of forgery and spreading false news. Candidate Emmanuel Macron filed a lawsuit. Consulting firm Bacamo Social issued a report this week that estimates a quarter of the links shared on social networks about the French elections are likely fabricated stories. Coming up, in-flight Wi-Fi provider Gogo reported a 17% surge in revenue from the last quarter and has signed deals with 9 satellite providers to keep up the pace. Is it enough? We will speak with CEO Michael Small next. This is Bloomberg. Airline Wi-Fi provider Gogo shares went soaring today after the company reported Q1 results. Gogo brought in record quarterly revenue of $165 million, up nearly 17%, topping expectations. And the company just struck a deal with Airbus. However, quality remains a concern. As of now, Gogo uses air-to-ground networks that offer internet speeds of 10 megabits per second, which is fairly slow, but the company is looking to change that. Joining us now from Chicago in an exclusive interview, Gogo CEO Michael Small. Michael, thanks so much for joining us. So let's start with, you had a strong report, but users still say that sometimes the satellite technology that your competitors use is better. What are you doing to work on quality?
What we're doing to work on quality is rapidly deploying 2KU, our proprietary solution. It's delivering industry-leading performance. It's fast, it works everywhere around the globe, and it works all the time. And customers are loving it wherever we deploy it. We're on over 170 aircraft with it today and expect to deploy another 1,500 more aircraft with 2KU.
What is 2KU? Without getting too far into the technological weeds, how is it that much better than the current technology?
We have a proprietary antenna design that goes on the top of the plane that points at the satellite, and it's just a better architecture. Our antennas are larger and rounder, and so they have a more powerful signal, and therefore we can get higher speeds more consistently all over the globe to our passengers. We've seen full planes use it all at the same time, doing whatever they want, streaming or browsing, and to rave reviews repeatedly.
Now, I just flew from San Francisco to New York, and I realize every experience is different, but I paid $33.95 for an in-flight pass. The credit card that I initially used was rejected, but when I landed, there were 5 charges on it that I had to then reverse. And the quality was very poor. I mean, the websites took an incredible amount of time to load. Some of them didn't load at all. On the way back, my credit card worked, but the speed was the same, and it was so slow that I just turned off my computer and turned on a movie. How do you address these things?
Well, I explained we need to bring more bandwidth to the sky, and I don't know whether you were on our flight or some other flight, but regardless, we need to get more capacity. And basically, we're entering an era where capacity is dramatically more bountiful. We used to peak at 10 megabits per second, and now we're offering a technology that'll be capable of 100 megabits per second. And not only is it faster, there's just more capacity. The speed limit's higher, but we have more lanes on the road, so we can handle a lot of passengers at high speed. And as fast as we can go, we're adding more aircraft with 2KU, and that'll do the trick. I would also say that we again announced on our earnings today that we have passed a major milestone with our next generation air-to-ground network, so using the cell towers. And today in the lab, just recently in the lab, we achieved over 100 megabits per second with that technology too. So we invented this technology. It got slow when it got congested, but we now have all the capacity everybody's going to need, and it's going to be coming this year and next.
It was a Gogo flight, just to be clear. What are you doing about hacking and security?
We run a public Wi-Fi hotspot in the sky, and it's as secure as any public Wi-Fi, but we work very closely with all the relevant agencies to make sure that we comply with the security requirements of the aviation industry. And top concern of ours, and we think we do a good job at that.
All right, Michael Small, CEO of Gogo, joining us there from Chicago. Michael, thank you so much for joining us. Coming up, SoftBank stays in the spotlight. When will the company's Vision Fund close? We will discuss next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang. It seems like ever since Masayoshi Son met with President Trump, SoftBank has been a near constant source of fascination. A lot of the headlines revolve around talks to invest in big tech companies around the world. But many wonder where the Japanese tech giant stands with this pledge to invest $50 billion and create 50,000 new U.S. jobs. Joining me now from New York, Steve Murray, partner at Revolution and a former partner at SoftBank Capital. He is also on the board of DraftKings and Fitbit. Steve, we'll get to the SoftBank stuff, but first I want to start with Revolution. You've got 2 decades of experience investing in Asia, which is a sector that Revolution doesn't focus on. Why make the move?
Oh, Emily, first, thanks for having me. I appreciate you taking the time to talk. I joined Revolution about a year ago. It's a great firm out of Washington, D.C., led by Ted Leonsis and Steve Case. We do a lot of investments in cities outside of Northern California. It's a great brand. It's a brand on the up and coming, and it's one that I was very comfortable with after a great and long career at SoftBank.
Now, Steve Case has talked to us a lot about his rise of the rest strategy and this idea of investing outside Silicon Valley. What's your vision for your own investments, and where do you see the most promise?
Yeah, it's interesting. It's been very consistent during our time at SoftBank Capital, and one of the reasons why I found Revolution such a great fit was we look at the world the same way, which is there's great opportunities in Northern California and Silicon Valley, but it's also an area where there's a lot of great firms with deep roots and a lot of money. So we've always, at SoftBank Capital and here at Revolution, we find that we can find great opportunities in other cities. So whether that be LA, Chicago, Boston, New York, Washington, D.C., Baltimore, Maryland, we find there are great entrepreneurs across the country, and obviously that's very consistent with Steve Case's Rise of the Rest program.
Does any one of those geographic centers stand out to you?
You know, it depends. Different. What we find is different parts of the country have different things that they're particularly good at. As an example, Atlanta, as an example, has a great fintech community, partly because they have such great history in payment processing. LA obviously has great video because of all the studio and video production that has been done there. We see great things out of Chicago now, in particular with respect to data analytics and machine learning, partly because of the great institutions that exist in Chicago. So each one of the pieces of the country that we look hard at has different things to offer.
Now let's talk a little bit about this SoftBank Vision Fund. There is so much speculation about it. It still hasn't closed yet, so a lot of people are wondering where this stands. I know you haven't worked there in a little while, but what's your take?
Yeah, so the SoftBank Vision Fund is really exciting. I'm still very close to a lot of the folks there. Ron Fisher, I was a partner with him for 20 years and still a great and dear friend of mine who helps lead that effort. I think that the SoftBank Vision Fund is going to be one of the most important technology investors, particularly in the private side, over the next several years. And so it's certainly an entity that at Revolution we're going to continue to stay close to. I think that that's a lot of capital to deploy. Obviously, they have a global focus, and they're going to be looking at big opportunities where they can put a lot of capital to work for long periods of time. I think when they set out their investment agenda, they're really quite clear. They want to find the next Alibaba, if you will, and are looking aggressively to do that. So I think you can't underestimate the importance of the Vision Fund over the next several years in the private markets because of the sheer size and aspirations that they have.
We hear though that the fund won't close for 6 to 9 months. What's the holdup?
That one I can't answer. I don't have any inside information on that one. I'm sorry.
Let's talk a little bit then about SoftBank in general. Nikesh Arora, who was the heir apparent there, is now out of the company. Masayoshi Son, is he the decider on these investments?
I don't know exactly how their investment committee process works, although I do know that Masa is very, very involved in the company. Some of the companies that I'm familiar with have worked with the Vision Fund recently. And as you probably know, if you've talked to Masa in the past, he's an amazing character. He has amazing passion for entrepreneurship, and at his heart, he really is an entrepreneur. So he loves to connect to new businesses. Entrepreneurs really value his input, and he gets deep into these businesses and can be very helpful. So I'm sure he's critically involved in a lot of the key decisions.
You're also on the board of DraftKings, which is in the middle of merger discussions with FanDuel. How do you see those two companies integrating strategically and financially?
Yeah, sure. So that process, I believe that the signed agreement to merge was in November of last year, and now we're awaiting a final ruling from the FTC over the hopefully next month or two about that process, and then can go about the business of combining the companies. There's been obviously some work that's been done on thinking through things like technology platforms and team and brand and approach and other things, but some of those, until the formal approval from the government, some of that has to be on hold. So hopefully that'll happen over the next 30 or 60 days, and we can get to work at what we think is building a really revolutionary company and a really exciting one that's changing the way that people interact with sports and information.
All right, Steve Murray, partner at Revolution and a former partner at SoftBank Capital. Thanks so much, Steve, for joining us.
Thank you, Emily. I appreciate it.
Meantime, Apple has $148 billion invested in corporate bonds, according to a new filing. And more than 90% of that debt is invested abroad. Apple announced on Thursday it's selling about $7 billion of its debt to help fund a higher dividend and stock repurchase program. Coming up, who will reign supreme in the battle over e-commerce marketplaces? We dive into Walmart's plan to take on Amazon next. This is Bloomberg. Walmart's feud with Amazon isn't just business. It's personal for Jet.com founder Mark Lowry. Lowry has been visiting Walmart regularly since the retail giant bought Jet.com last year. His goal is to help Walmart topple Amazon's dominance in retail. Earlier, I spoke with our Bloomberg Tech senior executive editor, Brad Stone, who did a deep dive on the company's e-commerce aspirations in the latest edition of Bloomberg Business Week.
It's still early. It's been less than a year, but the last quarter in February, when we got a Walmart earnings announcement, e-commerce growth was about 28 or 29%. So that is not only far above the industry average, it's actually above Amazon's growth rate. Now, Walmart is starting from a much smaller base, but it was a promising sign, and Walmart's investors reacted quite well. The stock has been up, so there are reasons for optimism. I mean, what Mark Lowry, the founder of Jet.com, has done at Walmart.com is he's kind of administered some of the medicine that Walmart needed. You know, he has broadened that marketplace selection, which Walmart kind of resisted for a long time. He has done what's sort of necessary online in terms of matching the lowest possible price. You know, Walmart historically was a little unwilling to do that because the store is supposed to have the lowest price. And then he's gone on an acquisition spree. ModCloth, Shoebuy, Moose Jaw. There are rumors about Bonobos, and so he's been pretty aggressive.
Why is he buying these smaller companies?
Yeah, for a couple of reasons. One, it's to bring product selection onto Walmart.com. So, you know, there are some brands that just aren't going to sell to an Amazon or a Walmart. These independent websites, and he's going to keep the websites going, have that selection. Some of the selection then he can bring over to Walmart.com or Jet.com. And then the third reason is he's getting some, very skilled founder entrepreneurs who he'll then put in charge of all of outdoor, all of shoes across all these Walmart.com properties. And so, in a way, it's a strategy to hire some great e-commerce operators.
What did he learn at Amazon that he's bringing to this moment?
Well, I mean, it's almost more interesting to talk about what he's not bringing. You know, what he almost learned not to do. You know, he's very sort of gentle, or I guess, or maybe reserved is the better word when talking about his Amazon experience. But one thing that clearly he left Amazon with a bad taste in his mouth around the willingness of the company to kind of empower the startups that they were acquiring. And so, you know, he continued to run the Quidsy business, or let's just say the diapers.com business at Amazon, but of course was competing internally with all sorts of other people that sold diapers. At Walmart, you know, Doug McMillon, the CEO of Walmart, has put him in charge of e-commerce across the board, and he's following that model. So when he went out and acquired the outdoor retailer Moose Jaw, you know, the founder, the CEO of Moose Jaw is now responsible for all of outdoor across Walmart. So he's empowering entrepreneurs in a way that perhaps he didn't feel empowered at Amazon.
So what do you think Walmart's chances really are of giving Amazon a run for its money?
The truth is that this is not a zero-sum game. You know, e-commerce is 10% of all of retail. It's only going up. You know, more and more people are discovering the convenience of just shopping from their couch or from their offices when they're supposed to be working. And so, you know, I think it's far likelier. The better question to ask is, you know, what are the chances that Walmart can create a sustainable and growing and profitable e-commerce business that kind of thrives alongside Amazon? I mean, Amazon is an unstoppable juggernaut. Walmart will never displace it, and of course, Amazon is, you know, an enterprise software company or a cloud computing company to a great extent now. So I don't think Walmart can unseat Amazon, but it does have its own advantages, and it's particularly strong in groceries. So I think it could lead in that category, potentially, perhaps in apparel. And you know, so the challenge there is to just create a growing and profitable e-commerce business that thrives alongside Amazon.
Our Bloomberg Tech senior executive editor, Brad Stone there. Well, DeepMap is a new startup focused on 3D maps, but these maps aren't for humans. Instead, they're designed to assist self-driving cars, so these cars can steer through complex cityscapes. Bloomberg Tech's Alex Webb reports.
If you're trying to control a robot, which is what we're trying to do, the robot needs to know within centimeters of where it is with respect to its surroundings.
A mile away from where Google builds their maps, a 25-person startup is doing the same for robots. DeepMap is building virtual maps which enable self-driving cars to steer through complex cityscapes.
We're running with a LiDAR and 2 forward-facing cameras. We collect all the data. Usually we'll collect it over several runs of the same location. We'll bring it into the cloud. We'll run a bunch of processing algorithms to create a single picture unified of all the runs of the data, of all the sensors of the data, and it will create a fairly high resolution 3D image of the area. From that, we can create and model down to very detailed accuracy all the geometric features in the road that are relevant to the self-driving car.
The team of former Google and Apple engineers is racing to beat Uber, TomTom, and Google itself to make the best 3D maps. Unlike Google and Apple Maps, the DeepMap system is aimed at helping robots navigate rather than humans. The 3D maps complement the car's sensors by giving them a detailed awareness of the environment outside the car's field of view.
So here we're seeing the usage of the map that we've created by a car that's driving. So now it knows that the lines are here, the signs are where the signs are indicated. And so now it can start making decisions about things in its environment and planning accordingly.
This is really the end product then of the maps that you guys have spent so long building.
Yes, this is the ultimate goal of using the map.
And with $30 million in venture capital funding, the company's confident it can navigate a path to success.
That was Bloomberg Technologies' Alex Webb. Well, the global tablet market continues to shrink. Shipments of tablets in the first quarter of 2017 totaled an estimated 36.2 million units, an 8.5% year-over-year decline. This according to market researcher IDC. The decline marks the 10th straight quarter that the market has shrunk. IDC attributes this to both an increasing dependence on smartphones and a lack of interest from consumers to buy newer devices. Coming up, Slack is opening a new hub in London. CEO Stewart Butterfield speaks exclusively to Bloomberg about the company's concerns about Brexit and a possible IPO. This is Bloomberg. Slack's CEO is going against the grain, saying the UK will remain a key market regardless of Brexit. CEO Stewart Butterfield spoke exclusively with Bloomberg's Nate Langson in London ahead of the official opening of Slack's new hub in the UK capital. Butterfield discussed why the company is laying down roots in the country.
We have a lot of customers, and ones that I think most viewers in the UK would recognize, retailers like Lush, broadcasters like Sky, Ocado, Sage Software. And we want to have a relationship with them and other customers yet to come on board. And it's much easier to physically be here. I mean, it's a sales-led office, but customer success teams and solutions engineering as well. And we're still going to grow. It's a country of 65 million. I should know that off the top of my head.
It's around that number, yeah. We keep expanding.
Yeah, good on you.
So tell me, one of the things that we see a lot of tech companies do is base themselves in Ireland, which is much less of a problem regarding Brexit. Right. We've had a lot of conversations and stories about companies considering other countries around the European Union. I mean, did you consider that? Did you consider Ireland as an option?
Oh, we already have a pretty large office in Dublin.
Right, okay.
We've been there for about a year and a half,
right,
like 70 people or so. And we're continuing to grow there. And as I mentioned earlier, eventually we'll open offices on the continent as well, just because we have customers in every country in Europe at this point. So we have 7 offices in 5 countries around the world, and we'll be expanding at a pretty good clip over the next 18 months or so.
Okay. Now, one of the topics there's been a lot of discussion about over the last 100 days or so, of course, is hiring and talent under the Trump administration. And I'm curious if that's something that has been affecting you, or that you're going to have to sort of think a lot more carefully about, over the coming months and years.
So. We started off with an office in San Francisco and in Vancouver, Canada. And Vancouver is a great city for many large U.S. tech companies who are having trouble bringing someone into the U.S., and so they bring them into Vancouver instead. And so that's been part of our structure from the very beginning. So it's been less of an impact for us. We also have offices in Dublin, as I just mentioned, in Melbourne, in Toronto, in New York. So the immigration issues have been less of an impact for us. I mean, I think the people who work at Slack as citizens are more concerned about it than I would say that I am as the chief executive of the company. But there is a general atmosphere of uncertainty, when it comes to trade policy, when it comes to tax policy, when it comes to immigration. And in that context, it can be difficult for businesses to make decisions. But there is obviously also a huge range of things that people have under their direct control, and luckily, communication software is going to be needed either way.
Right. Yeah. I mean, the talking about talent and sort of acquiring talent, particularly internationally, is another issue that we're having to consider quite seriously in Britain as well. A lot of talent comes from the continent, and that causes, can be caused, great problems can be caused, let's say, because of Brexit. I mean, do you have to consider sort of both sides of the Atlantic and the talent?
Yeah.
space?
Well, I mean, We don't have a great number of remote employees now, but it's something that I think as we get larger and more mature as an organization, we'll be able to accommodate. So if are great people who we can't get into one of our offices, we can consider opening an office in that location or just bringing them on and having them work remotely. As I said, though, it hasn't been a big problem for us yet. It's an incredibly competitive market, but because we've been growing very quickly and because of our presence in the tech industry, I mean, I think there's very, very few technology startups in the San Francisco Bay Area that aren't existing Slack users, which gives us a huge leg up in recruiting because people are very familiar with the software. And if you're in the Bay Area, especially if you're in tech, the perception is that everyone uses Slack, and so people want to go where they have a big impact, and we have a big recruiting advantage as a result of that.
So we're coming up to the end of our time here today, but I've got to ask, of course, what's next for Slack? Do we have an IPO in sight anytime in the near future?
IPO would be years away. We're growing at a pretty fair clip still, and one of the things that side effect of that rate of growth is that predictability is hard, so not the kind of predictability that they would want in the public markets. But the good news is that the private capital markets are very friendly to companies like ours right now, and so there's no need for that public offering. So the focus is absolutely on growth in customers and increasing the value of the core product. So we're doing a lot of work on machine learning and AI and bringing those things to market over the course of this year.
That was Stewart Butterfield, CEO of Slack. Just a disclosure, Bloomberg Beta, the venture capital arm of Bloomberg LP, is an investor in Slack. And that does it for this edition of Bloomberg Technology. We are live streaming on Twitter. Check us out there at Bloomberg Tech TV weekdays, 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg.